Hey everyone, welcome back to another episode of Home Buying Secrets. Today, our guest is Chris Chan, who is a real estate investor. Chris, could you give us tell us more about your background and how you got into this?
Yeah, so by background, I'm an engineer. I worked in tech for 10 years, and then I got a midlife crisis. I decided didn't want to do that anymore. So I left my job in 2016, started doing some real estate. In 2017, I did a bunch of crypto. So I had my own small consultancy firm where we were advising crypto projects on how to ICO, how to create their coins, tokenomics, all this stuff. So I went into that in 2017, 2018. And then in 2019, I decided to go more into the real estate side of things. And that's where we are right now.
Great. Can you describe kind of your views on real estate as an asset class and what, how you are thinking about and investing in real estate?
Right. So I think, if you want to even just step back and just talk about investing in general, I think the biggest question is how much risk are you willing to take, right? Different asset classes have different risk profiles. Real estate in general is a much safer risk profile. It has less risk because at the end of the day, you have a hard asset, right? If you're investing in equities, if you're investing in the stock market, you're investing on the basis of strong cash flows. But the IP of the company, which makes them money, is not an asset that can easily be bought or sold. Versus when you're buying real estate property, obviously you want to make decent cash flow, and cash flow is one component of a real estate deal. But the second part is that there's an underlying value of that home, which we've been in a bull market for 30 years, right? So if you started investing in the 90s, it doesn't matter what you were doing, you're going to make money, right? You could have picked the worst deal and it honestly doesn't matter, right? So there's some aspects of real estate, which honestly, I think a lot of real estate investors got very lucky with the timing, right? If you bought in the 90s, you're good. It doesn't matter where you bought, what you bought, as long as you just sat and hold, you're okay, right? Which you can't say that about any other market, right? You can't say that about equities. If you invested in, I don't know, any like pets.com in 2001, it's a loser, right? Versus investing in Amazon. I think if you're looking at investing in general, you want to split up your assets into several different asset classes, right? You want to do the stock market. Stock market on average returns 9% a year, and that's over the last 100 years of data, right? Bonds return on an average between 2 to 4%. It's, something that won't default, but it won't give you high returns. Real estate as an asset class on average returns around 4% a year. And that's also over the last 100 years. Of course, what makes real estate different is that it's hyper-local, right? So if you bought in California in the 90s, you're doing great. If you bought in Texas in the 90s, maybe your appreciation hasn't been as high, right? So this is how I looked at things, right? In 2008, 2009, and I was like, why would anyone ever get into real estate when the average returns are 4% versus the equities market, which is on average 9%? And if you know a little bit of what you're doing and you're just investing in tech, maybe it's 20 or 30%, right? And it took me a really long time to figure this out. Obviously the risk profile is less, but I think the killer advantage of real estate investors here in the US is the mortgage, right? So there is no other asset class where you could get 5-to-1 leverage and make a bet on something, right? So if you're buying a house, and this is your first house, typically you could do, let's be conservative. Let's talk about 20% down, right? I know you could get 15% down. You could even get 5% down. But let's talk about 20% down. 20% down, you're at 5-to-1 leverage. You're putting 20 cents on the dollar. So that 4% return becomes a 20% return. And that's the killer advantage if you're investing in a bull market. Of course, this works the other way around. So if your property is going down by 4% a year, you're losing 20%, right, of your investment. So to keep math simple, let's say it's a $500,000 property. You put $100,000 down, right? If your property is losing 4% a year, so let me see if I could do the math in my head right now. That's $20,000, right? If you in your first year, your property goes from 500K to 480K, and you sell within that year, you've lost 20K, right? You put in 100K, you've lost 20K. That's a 20% loss,
Yep.
right? So I think that's the danger, and that's also the allure, right? So there are a lot of real estate investors that got very wealthy up until 2007, and then a lot of them went bankrupt, right? Because they over leveraged. You can't make a 5-to-1 bet as a single investor, as an individual, in any other asset class. You can't do it in stocks. You can't do it in anything else where the rates are so low. Like, for example, right now, you could probably get a 2.5% mortgage. That's crazy, crazy low. If you're looking at the stock market and you want to play on margin, the margin percentages are like 10 to 15%, right? Because of the high risk involved. So I think that's the secret that took me such a long time to understand and really get on board with is leverage.
I love that concept of leverage because none of our guests have brought up that topic, but it makes perfect sense. And I'm going through this right now where I did 10% down. So I could definitely see how if it goes up or goes down, it kind of amplifies it a bit. Now, one thing I want to ask you is, you were saying as an individual, there's no other better mechanism or kind of financial product where you could have leverage. But what if, what makes you decide whether you want to work by yourself or with a group? Because I've heard of situations where, you could just start like a real estate syndicate. You don't have all the capital yourself. Is it because you're basically reducing the risk and therefore your returns? But for you, since you know kind of what specific niche or thing you're targeting, you control all the risk and get all the kind of rewards that you're comfortable with.
Right. I think commercial real estate is a bit of a different game. The deal structure looks different. And, I'm not an expert in this space because I don't really play in commercial real estate. But generally, I'm not sure what the term is, but maybe you could call them the sponsor, the person or group that finds the deal, they get a percentage of equity, right? So if they're trying to buy an apartment complex for $10 million, they will typically take 20% of equity for getting the deal through. So obviously they need to raise money from private investors. They typically also put in some of their own money, and they also need to find financing, right? So they need to have the deep relationships with the banks that will let them make the deal make sense. But they also take 20% of equity, which 20% of a $10 million deal, that's $2 million, right? So their incentives are really aligned. As a sponsor. As the investor, I think that the deal is a bit worse, right? The advantage of this as an investor is that you're a passive investor, right? You don't do anything. You just get a check every month or at the end of the year, and you get a K1, and that's it, right? You don't put any work. And when it comes to buying apartment buildings or complexes, the name of the game, from what I've read, is improvement, right? You want to turn a $10 million asset into a $20 million asset. And the way you do that is by improving the rent yield. So if you're getting $500 a month and you have 20 doors and you improve it to $1,000 a month, suddenly the value of the property has doubled, right? Because everyone's just looking at the cash flows. I think in that respect, it's kind of like flipping houses, right? Just on a larger scale. And I think the market, for me, at least when I look at the market, I think the market is relatively crowded. I have friends who invest in this space, and it's again the concept of leverage, but I think the winners in this space are really the sponsors, not so much the investors. The investors, you'll still do pretty well if you get lucky with the right deal. But it's really the sponsors that make out. So if I were to make an analog to the wider financial market, they look kind of like SPACs, right? So SPACs, the way the structure works out, the sponsor typically takes 10 to 20% of the float, which is like something that is not talked about as much during SPACs, right? So whoever is sponsoring, like, I don't know if you're following any of the big players, but Chamath, he went from $2 billion to now he has $12 to $13 billion because he went crazy with SPACs and sponsoring a lot of very high profile SPACs where he made out like a bandit, right? And I think that's timing dependent. You have to be a good investor / trader. And I would say I'm not a trader. I like risk-free, as risk-free as possible assets that I don't have to think about. I don't have to worry about the timing about. And, just like SPACs, I think commercial real estate, it's hard to play in a crowded field, right? You could spend months sourcing a deal and if you don't win that deal, then that's it, right?
So let's talk about. No, I think that makes perfect sense. Actually, the last guy we had on the podcast, Ryan, his company basically is a sponsor for these deals, and they also own and operate some as well, which is interesting. So let's talk about the individual then. Let's say, okay, you are an individual, you're buying properties. What are the avenues you can take? You can rent them out. You can Airbnb. Is there like a third option or fourth option I'm missing here?
Right. So when you're looking at real estate as an individual investor, there are two ways to make money. One is cash flow and one is property appreciation. Cash flow typically isn't that great. So when you're talking about long-term rentals, the kind of apples to apples comparison that real estate investors use is cap rate, right? So cap rate, I believe, let me see if I remember this correctly. Cap rate is net income divided by purchase price or amount invested, right? So let's say, again, you have $100,000 property and it gives you $6,000 a year. That's a 6% cap rate. That's close to a 6% cap rate. I'm assuming that if you're not making any repairs on the property, that all that rent that's coming in is just pure income, then that's a cap rate of 6%. And generally, from what I've seen, is that a good cap rate is between 6 to 8%, like a really good one. If you're making 8% on your investment, that's really great. It's still not equaling the stock market though, right? So the second component of that, and this is why I do like real estate, and if you're savvy at real estate, this is great, is that it's multidimensional, right? So you're making money on the cash flow. Number two, you hopefully are also making money on appreciation, right? However, nobody can predict the market. Nobody can predict where the market is going to go. So far in the US in the last 30 years, it's been a great real estate market, but this is just specific to the United States. If you're looking at Japan as an investment profile, Japanese real estate is a horrible asset, right? It doesn't appreciate. If you have a new building and you use it for a few years, suddenly, it's not like in the US where the value of the building appreciates. In Japan, it doesn't appreciate at all. People just want new buildings. So it's kind of a weird thing where we've been brainwashed a little bit to say, to believe real estate's always a good asset. It's always going to go up in value. You're throwing your money away in rent if you're just renting. And I would take a more nuanced view of that. There are advantages, there are disadvantages to owning real estate. And by far the biggest advantage is leverage, right? If you're buying in the right market, but you could easily go the other way around. If you're going to pick an individual stock, you really should know what you're doing. You should understand the market. You should, be a savvy trader, right? And buy things that look good. Otherwise, if you want to invest in the market as a whole, there are a ton of REITs that are doing great, right? And I believe the average return on REITs is 15%, So that's a great way to kind of invest in real estate without buying a house or buying a single individual property, which is risky, right? You could buy Apple or you could buy pets.com, right?
Yeah, that's a good point. So since you own a couple properties or you mortgage a couple properties, can you talk about some misconceptions or difficulties or interesting things you found about like just owning properties and renting them out?
Yeah, deferred maintenance is one of the big killers. Everything always needs work. I've replaced 6 or 7 AC units. in the past 2 years. There's just a lot of maintenance, which when you're running the equations, people don't really think about or they minimize, right? So I believe the safe ratio that real estate investors look at is they look at you're going to be spending 1% of your property purchase price every year in maintaining the property. Most of the time it's small stuff, but once every 10 to 15 years, you got to replace the roof. And that could be a $10,000 charge. That could be a $15,000 charge, right? And when you're paying straight cash for that, that really, really affects your cash flow. Maybe your 6% cap rate is suddenly 3% cap rate, or maybe you're just cash flow neutral because you didn't check the condition of the roof. So one thing I've learned over the last few years of investing when I buy new properties is I always do a few things. I always get my plumber to check the sewer lines. If the house is older than 50 years old, it is likely they used cast iron, and cast iron has a shelf life of about 50 years, right? After 50 years, it just like rots away. I always send my roofer to check the roof. Do not trust your home inspection to check the roof. Usually they will just send a drone up there. You want to send an actual roofer to take a look at the roof and make sure it's in good shape. Only the roofer is going to know. The home inspector, he's a generalist, right? You want to get specialists. And lastly, because I'm here in Vegas, I get my AC guy to take a look at the AC units as well. So those are the three things that I always do on top of the home inspection.
So are these just people you found that you work with repeatedly, or are they like part of like your team and they do all sorts of stuff for you?
Yeah, no, these are people that I've found and I work with on multiple occasions. Yeah, but and they have their own businesses where they are plumbers or they are roofers or they are AC guys. So yeah, I think it is really, really important to find somebody or find your team that you trust to tell you the right things and give you accurate quotes, right? Part of that is leverage when you're making an offer, and you could provide backup. Hey, like in 2 years, I'm gonna have to replace the roof or the AC unit, and this is why, I'm countering at this price versus this, right?
Got it.
And number two, you want the real price. You want good prices on things rather than someone who's going to charge you double the going rate and provides a subpar job, right?
All right, let me bring Chasen in for a second. So Chasen, can you tell us about the difference between getting a mortgage for your primary, home versus an investment property? Is it just like a higher interest rate?
Yeah. So if you're getting a mortgage on a primary residence, A, you're going to have a better interest rate, but B, you also have more options in terms of down payments, right? So if you're buying something to live in, you can put as little as 3% down if you really wanted to. On an investment property, depending on the type, I mean, you're limited to 20-25% down. You're also going to have a higher interest rate on top of it.
Okay. And can you explain the concept of maybe this is multiple concepts together, but the concept of, let's say you are buying a property that's not great, you're fixing it up, you rented it out, and then can you do something like a cash out refi?
Yeah. So, I mean, there's a couple different ways that you can do it. If you're buying something that's livable and in working order, then you can buy it, get a mortgage on it, fix it up while you live in it, and then down the line refinance it and pull more cash out if the value goes up. Some investors will use a strategy where they'll buy something that's completely unlivable, but you're not going to be able to get a mortgage on it. So in that case, you would buy it in cash, fix it up, and at that point then refinance, try to pull as much money as possible out. One of the methods people will use, they'll try to basically get all of their money out. So I mean, just for basic numbers, let's say homes in the neighborhood cost $100,000. An investor might try to find one for 60,000, put 15 into it to make it worth the 100, and then refinance. You can pull 75% out on a non-owner investment property. Now you have your full $75,000 cash. You've got a $25,000 equity cushion there, and then you can take that money and go use it and do the same thing over and over again. Those are different strategies that people will use.
Cool. Okay, back over to you, Chris. So let's talk about kind of Airbnbs because I have a lot of friends who've stayed in them. So once again, I think it's kind of like what you're saying. Like everyone's a real estate investor. Everyone's everything once you stay in it once, right? So can you talk about like the operations of running an Airbnb, like the basics?
Right. So this is one thing that I do see with a lot of real estate investors who, have either fallen into or targeted Airbnb, converting their real estate portfolio into Airbnbs. You're really in hospitality. You're not in real estate. So hospitality rules apply here, where you want to make sure your guest has a good time. You want to fix up the property, obviously, to the right standard. But a lot of guests, especially now, they're expecting hotel level amenities, right? I think it's an area which has much higher profit margins, but is much more involved. When you're looking at a long-term rental, once you get the property occupied, you just get a rent check every month. Generally, there aren't any issues with the property. That's passive income, right? Versus a lot of Airbnbs, especially for people just entering the space or dipping their toes in where they maybe have one property or they're trying it out at their house and they're renting out a room. It's really, really involved. You gotta figure out your team, your handyman, your maid cleaning service. And for a lot of these people who only have one unit, they're cleaning it themselves, right? You've basically bought yourself a full-time job. You got to respond to the guests, at all hours, right? If your guests are out in your backyard throwing a party at 2 a.m., you're up too. You're going to get nasty calls from your neighbors, right? And that's the part of the job that a lot of people don't think about, which comes with being, in hospitality, right? You are on 24/7. You have to think of yourself as a mini hotel, right? The good and the bad. And on top of that, you have to manage your relationships with your neighbors, right? So, and I'm not even getting into the licensing aspects of things. There are a lot of areas where Airbnbs are not allowed. And so licensing, I think, is one of the biggest hurdles. So you'll see a lot of there are actually a bunch of YouTube videos on Airbnbs and, how to run them. And, some of these videos share some of their numbers. So, anybody in the audience can look up some of these videos to understand a little bit more of that side of things. But what these videos don't talk about is the downsides of running this business where you're always on call 24/7. And it's really, really hard to scale out of if you only have one property. If you have one property, you're doing almost as much work as if you have 3 properties. So really the only way to go here is to scale out, so that you could start to build your team, so that you could start to hire people to handle these issues for you.
That's a good point. I'm going to turn it over to you, Frank. I'm not sure if you've encountered this, but since you represent buyers, do you have any buyers who actually say like, hey, Frank, I'm looking for a property that I'm thinking about, or I definitely know for sure I'm trying to use it as an Airbnb, or are you just usually encountering like people who are buying for their primary homes and later down the road, they may decide to convert?
Yeah, almost all of it is primary or even just a straight rental. I don't know a whole lot about Airbnbs other than just staying in them. But from what I'm told, like in Orange County, there's only a few cities that will allow you to do it, and all the licenses are bought up. So there isn't somebody that comes to me and says, Frank, hey, I want to go buy an Airbnb in Anaheim. Like you just can't do it in Orange County anymore. It's been that way around the beach cities for some time now. But now it's pretty much broadened. Haven't really done much in LA County. Well, I sell a ton of real estate in LA, but same thing. Airbnbs, I'm not sure what the rules are. I do know though, when I'm looking at, like, say somebody wants to buy a house in Anaheim and I'm looking at, say, the comps, it's crazy where I'll see one house that's for sale like near Disneyland and the asking price is say like 800,000. And then you got one that's almost the exact same house, but they have turned it into an Airbnb. And now they're selling it for like 1.2, 1.3. So I do see that massive price jump between a licensed Airbnb and then your just regular old house. But yeah, I don't know what the rules are. I've been told that you really can't go in new and do an Airbnb in Orange County right now. You have to buy an existing one, and they charge you a lot for them.
Jason, did you have anything to add?
Yeah, so I mean, I don't know too much about Airbnbs myself. I don't have any or run any, but I have been looking recently in Big Bear for kind of a second home slash Airbnb. So I've been kind of diving into a lot of this stuff, and I'm wondering from Chris. You mentioned licensing is one of the issues. I'm wondering if there's any other types of just kind of things that you didn't know until you started doing it. Like in Big Bear, for instance, I recently talked with a client of mine who just bought an Airbnb in Big Bear maybe 6 months ago, and he was telling me all these things he didn't realize. Licensing fees were one of them. There were other like state and local fees he didn't know about. He even went as far as his utilities were higher than being an Airbnb than if you actually lived there. So there were all these different things hitting his bottom line that he never saw coming. So wondering kind of what other things should people look out for, Chris?
So one part of it is there's the number side of things, right? Which you want to have as accurate a pro forma as possible, so that you could understand what your costs are. But I will say roughly about half the income that I generate from any one of my short-term rentals goes to expenses. So let's say that a property makes $100,000 a year. 50,000 of that will go into expenses, which that is not the case in long-term rentals at all, right? Usually, if you're making $100,000 a year in long-term rentals, almost all of that goes into net profit, right? So that's one thing that I think people misunderstand, the high costs of running basically hospitality, right? Part of that is increased wear and tear. Guests are monsters. If you have long-term renters, at some point they will learn to understand the house, right? If there's a squeaky faucet or you have to turn it a special way, they get used to it, right? And they'll baby those parts of the property. Versus if you have new guests coming in every week or every other week, they're not going to know anything, and they will just break everything, right? So you have to make everything super, super baby proof, right? Because if something's going to happen, if there's a bad scenario that you envision in your head, it's definitely going to happen. It's just a question of when, right? So again, with real estate, just in general, because historically the profit margins are relatively low for cash flow compared to other asset classes, like as I said before, 9% in the equities market versus 4 to 6% in real estate. Real estate investors try to shave every single expense that they can, right? And that's kind of built into the mentality of real estate investors. One thing I will say is that insurance for a short-term rental is about double a long-term rental. So that's an expense that a lot of people don't even think about. They're like, oh, why should it be, or rather, the thing is they just don't think about it, right? Short-term rentals as a real estate class is a different usage of the property. And so obviously it'll need to have different insurance, right? And people don't understand that because it's such a new thing and coverage is kind of weird. No one's really figured it out. So yeah, insurance coverage on that is about double, which that's one of those things that you don't really know till you get started, right? And you get some quotes if you're going to get insured at all. Most big insurers won't even insure you if you say that you're running it as a short-term rental. I believe that Geico will give you short-term rental coverage through Travelers. And I think that's the only big company that I've found that will insure short-term rentals, other than the smaller companies like Proper Insurance, et cetera.
Hey, Chris, I thought I saw something like about Airbnb directly insuring their properties. Do they have any sort of policy that rides with property?
No, they don't. So Airbnb is great at marketing. They tell you that if you have an adverse effect, they will cover you. That is not insurance, though. That is their dispute resolution process, which supposedly they have $1 million policy, but no one's ever, put it to the test. And Airbnb is just, they have a great team, great marketing team. So I think a month and a half ago, there was a family who went down to Mexico and they vacationed, and the parents both died of carbon monoxide poisoning. Didn't hear anything about it because the first thing Airbnb does is they will contact the family and settle with them, right? Which I love Airbnbs. I love using them. But Airbnb is a big corporation, right? And what they care about is their image and their reputation, because that's all they got, right? They don't own property. They just take 15% off the top. So if they are known as an untrustworthy platform on both the host and the guest side, no one's going to use them, right? Airbnb doesn't charge for their insurance. It's not really insurance. You still need to get insured for your property.
Chris, one thing I've always been super curious and never have found any real good answers, and maybe you can break it down. If I'm seeing like an Airbnb rental, and let's say the price is $250 a night, somebody books it for 2 nights, and then I look at the price breakdown, right? So like $500 of rent, $125 of a cleaning fee, $75 of an Airbnb fee. What of that does an owner see versus what goes to Airbnb? Like, where do the fees come in and out of? Because that's stuff I haven't really been able to find, and I'd be curious to hear kind of just an expert's breakdown.
Yeah. So I could talk about the breakdowns in a regulated market. So there are 2 ways to go about it, right? One is to try to do things correctly and above board and get licenses and permits. And part of that means you are paying a certain portion of your income to the city. So here in Las Vegas, we pay the hotel tax. This is the tax that the hotels pay as well, which, probably makes sense. They pay it, so should short-term rentals. And that is 14% of gross. So if you're, charging $100 a night as an Airbnb host, $14 off the top goes to the city. Between 14 and 20% will then go to Airbnb as a platform. So you'll lose another, let's say $15 to Airbnb. And then you have cleaning fees, which, typically go to your cleaner, right? So if you're, charging $100 a night, you'll see $70 of that. Plus, out of that $70, you still have to pay your cleaner, which is why a lot of people who only have one property, they clean themselves and they undercharge their cleaning rate, right? So rough numbers, 30% is going to go to somebody else. However, if you're doing things under the table, which I believe 60 to 70% of all Airbnbs are unlicensed and unpermitted, then you get that 15%, that 15% back, right? Since you're not paying the city, the risk is that the city will catch you or your neighbors will catch you and call you out, and the city will fine you, right? In Vegas here, I believe because they've had so many issues with unlicensed and unpermitted properties, they do $1,000 a day. Right. The fine could be up to $1,000 a day.
Wow.
So I'm not gonna say, I have a lot of friends or competitors that are running unlicensed short-term rentals. It's definitely a way to go, especially, in cities like Orange County, right, where you can't get a license. So probably 90% of the listings that you see on Airbnb are probably unlicensed. It's a way to go. It's just you really can't sleep at night because you're always worried that someone's gonna rat you out, right?
Do you currently live in Las Vegas, or only your investments are in Las Vegas?
I currently live in Las Vegas.
Okay, great. Because in a previous episode, we were talking about a lot of Californians, which the 3 of us are in, moving to, either Texas or like Austin or maybe like Miami in Florida. I also have a lot of friends and heard about a lot of colleagues, especially in California, just moving to Nevada, to Las Vegas. This is more of like a general, just like your perception. Have you seen like an influx of Californians during COVID? And if so, do you personally know of a couple? And another follow-up is like, if you've talked to them, do they have any like regrets, or do they like moving? Because one of Chasen's point is, you could go anywhere for a weekend and like it, but you'll have to live there for like a couple of months to really know if you like the area or not.
So I could address this a little bit more generally, and then we could, talk about specifics. But I have been reading that there are a lot of people that have moved out of California in general. just because of the high prices. And if you're a real estate investor and you're buying at $1,000 a square foot, maybe it'll go to $2,000, but it seems like a better investment to buy in an area where the price per square foot is around $200, and it's relatively easy for that to go to $400 or $600 versus $1,000 to $2,000. And I think that's a state of affairs in California. You know, LA is $800 to $1,000. San Francisco is $1,000. You know, I moved to Vegas last year in the beginning of the pandemic, you know, and I lived in San Francisco for 10 years before that, right? So, you know, I seen it. I'm one of those people that moved over. And I've been investing in the Vegas area since 2016. So I've seen the prices go up. I was buying at $120 a square foot in 2016, you know, and this is market rate, right? So I'm not looking at flipper deals or buying, you know, condemned properties or anything, which you could always find steals, right? If you want to put in the sweat equity. But right now, the price per square foot, I'm looking at $200 a square foot. So it's definitely gone up. Even in the last year and a half, it's gone up by 30%, the real estate market here in Vegas. Nobody has a crystal ball. If there's anybody telling you, hey, real estate will go up or down, you should definitely stop talking to them or stop listening to what they're saying. I really thought in the beginning of this year that we would hit a recession, right? And it hasn't happened. It looks unlikely that it's going to happen as long as the Fed is continuing to prop up, you know, the market and continuing to spend. And now we have a big infrastructure bill, right? So the situation has totally changed around where I didn't let my personal thoughts of a recession happening change my investing thesis, because you have no clue, right? None of us have a clue. It's the same thing with the equities market. People were afraid of getting into the equities market in 2014, 2015, because they're like, oh my God, it's been going up for 5 years. And they missed out on the greatest bull run in the stock market that it's ever been, right? You have to take a long view. You have to take, you know, many cycles of investing. So it doesn't matter whether you're really buying at the top or the low in a specific cycle, as long as you're willing to wait it out, right? So a lot of people say that a real estate cycle is 7 to 10 years. I'm not sure how true that is, but it is not just a 1-year process. It's a multi-year process. Same thing with the stock market, right? As long as you're getting into the market and you're getting exposed over 20 to 30 years, you're going to end up in a good situation, right? At least historically. So yeah, I hate the fact that I'm buying at $200 a square foot now in Las Vegas, but what are you going to do?
Well, let's get more tactical in the sense of now that you've lived there for a year, like, how do you enjoy it? Once again, you know, this is from my only concept as, you know, a typical Californian just going to Vegas, you know, maybe for a weekend or not. Basically, my questions are, is it just intolerably hot during the summer and like, do you just escape, do you go somewhere else? Or is this why you need to replace your ACs all the time and people just stay indoors and maybe they do activities at night? Like, you know, what do people who live in Las Vegas do? Because I think we know a lot about what tourists do.
So me personally, I love the heat. I lived for 10 years in San Francisco, you know, on the west side of the city, which is just foggy and 50 degrees all day. And so this heat is great. I love it. Even 120 degrees, it's fine. I may have a different opinion in a few years, but right now I love it. Vegas is a great city, I think. There's a reason why a lot of people moved to smaller cities during the pandemic. And one part of that is they want land. They want a backyard, they want a front yard. And cheaper cities or cheaper areas like Texas, you know, or Phoenix or Las Vegas, you could actually buy a house and have room to stretch out. And there's still a lot of open land left. Vegas, I believe, has 2.5 million people, and you could still see a bunch of empty plots of land. The food's great here. We have a world-class food scene. And the freeways and the highways are in great condition. You know, I could get from Henderson, which is the south end of Las Vegas Valley, to the north side, North Las Vegas, in 45 minutes. That's 40 miles away. which is great. You know, compared to San Francisco, it could take me an hour and a half to travel 7 miles, right? And the situation's not any better in LA, right? Where you're just hitting traffic all the time. So those are some of the things that I really like about Vegas. And that's just because it's a modern city, you know, it's a constructed city versus LA or SF where they're older cities, you know, they didn't account for cars and traffic.
That's a good point. I do recall when I don't like staying on the strip. So when I visit Vegas, I'm always off the strip, and I found it just going from place to place remarkably easy. There's like no cars really, and even on the strip, they've designed it in a way where somehow it's kind of easy to get in and get out. All right, Chris. Well, thank you so much. This was a really good discussion on just general real estate investment, and appreciate your time today.
Yeah, no problem. Thanks, guys.